Imagine waking up, picking up your phone, and checking your bank account as usual. At first glance, everything seems normal. Your balance is there. Deposits went through. Nothing looks out of place. But behind the scenes, something has shifted, and most people have no clue it's happening. Starting in 2026, a single number, $10,000, could quietly determine whether your financial activity gets flagged, reviewed, or questioned. What's catching so many people off guard is that it's no longer just about large transactions. It's about patterns, timing, and how your money moves. Even if every dollar is legitimately yours, even if you haven't done anything wrong. For millions of retirees living on fixed incomes, managing savings carefully, helping family, or simply moving money between accounts, ordinary behavior can suddenly look suspicious to a system that doesn't know you, doesn't know your history, and doesn't care about intent. Once you're on that radar, the consequences can range from a simple letter to far more disruptive outcomes. So, what exactly has changed, and why are seniors at risk without realizing it? Hi, I'm Timothy, and in this video, I'm going to walk you through precisely what the $10,000 rule means heading into 2026. We'll cover what's happening behind the scenes, why it affects seniors more than almost anyone else, and break it down in a practical, clear way. No jargon, no fear tactics, just what you need to know to protect yourself and stay in control of your finances. I'll also share real-world scenarios that seem completely normal, but can trigger attention under the current system. And most importantly, simple steps to prevent problems before they start. Once you understand how this works, it becomes much more manageable. One example makes this very real. Meet Patricia. She's 71, a retired school teacher who spent over 30 years in the classroom. She lives a quiet, structured life, managing her finances carefully. Each month, her Social Security check deposits into her account. Occasionally, she transfers money from savings for medical bills, home repairs, or visits to see her grandchildren. Nothing unusual, nothing risky, just the routine millions of seniors follow daily. She's never tried to hide money, never missed taxes, never done anything questionable. But under the systems expanding in 2026, Patricia's normal behavior could appear unusual. Not to a person, but to an automated system trained to detect patterns. The system sees deposits, transfers, timing, and amounts. If patterns don't align with what's reported, they trigger attention. Not because something is wrong, but because it doesn't perfectly match expectations. This is where so many get caught off guard. To understand why Patricia and millions like her could be flagged, we need to trace this back to 1970 when the U.S. passed the Bank Secrecy Act. The goal was straightforward: give the government a way to track serious financial crimes like money laundering, drug trafficking, and tax evasion. Banks were required to report cash deposits or withdrawals of $10,000 or more, known as a currency transaction report. For decades, that $10,000 threshold remained unchanged. But here's the thing most people don't realize. It was set over 50 years ago. Adjusted for inflation, $10,000 back then is roughly $80,000 today. Transactions that were once unusual are now commonplace. Retirement distributions, home-related expenses, or certain savings transfers can easily reach that level. But the system never updated. So why does risk feel higher now? The answer lies in something most people have never heard of: structuring. Structuring is when someone breaks up a large transaction into smaller amounts to avoid the $10,000 reporting requirement. Depositing $9,000 today and $9,000 tomorrow instead of $15,000 at once is considered a red flag, and in serious cases, a federal offense. The complication is that the system doesn't understand intent. It only sees patterns. That's where seniors often run into trouble. Many older Americans prefer cash, keep money at home, or make smaller, frequent deposits because that's how they've always managed money. To a machine, that behavior can look like trying to avoid reporting rules. Real-life cases exist where law-abiding individuals had accounts flagged simply because their habits didn't match the system's expectations. No criminal intent, just a mismatch between human behavior and machine interpretation. Once flagged, a chain reaction can begin. Accounts can be reviewed, transactions questioned, and in serious cases, funds frozen while investigations occur. Most people think the $10,000 rule hasn't changed. That's true. But the enforcement has, and 2026 marks a turning point. Reports that once sat in massive databases are now analyzed automatically. The IRS has better systems, advanced technology, and tools to detect patterns instantly, cross-referencing deposits with reported income, tax filings, and financial history without a human ever reviewing it first. Now, the system interprets money movements. If deposits or patterns don't match income or tax filings, it flags them. Seniors are uniquely vulnerable because retirement finances are complex. Multiple income sources, irregular withdrawals, and uneven transfers can stand out to automated systems. Even perfectly legitimate behavior like retirement distributions, gifting to family, or managing large expenses can trigger scrutiny if patterns don't line up clearly on paper. Other everyday situations that can trigger attention include retirement distributions. IRAs, 401k withdrawals, and RMDs often exceed $10,000. Even legitimate distributions can trigger flags if they don't match tax records. Gifting money to family. Multiple large or repeated transfers, especially in cash, can create patterns that look unusual. Major life events. Selling a home or receiving an inheritance can produce large, legitimate deposits that stand out sharply. Cash-based habits or informal arrangements, selling personal items, collecting rent, or holding money for family temporarily, can resemble structuring. Once flagged, the bank files a report to a federal database managed by the Treasury Department, accessible by the IRS for analysis. Often, nothing happens, but if a mismatch exists, it may escalate. Letters, audits, account restrictions, or temporary freezes. The burden can fall on you to prove your money is legitimate. The good news: the vast majority of reports never lead to action. Millions of transactions are flagged each year with no follow-up. But the system is now more precise, focusing on patterns that stand out. The goal isn't to avoid the system. It's to ensure your financial activity is immediately understandable if reviewed. Here's how to stay in control. Keep clear, organized records, monthly statements, closing documents, inheritance paperwork, retirement account statements, and any gifts. Date, amount, purpose. Documentation is key. Work with the right professionals. Tax advisors or attorneys familiar with retirement finances can help ensure filings and transfers are clear and compliant. Avoid breaking up transactions unnecessarily. Large sums are safer if handled in one documented transaction rather than multiple smaller ones under $10,000. Additional steps include understanding your rights if contacted, keeping family transfers clear and documented, and maintaining organized accounts when assisting others with finances. Confusion, not wrongdoing, is the main cause of flagged activity. Finally, beware of scams targeting seniors. Instructions to move money quickly or in smaller amounts can mimic suspicious patterns, leaving a trail that looks like structuring even if you were misled. Pause, verify with trusted advisors, and avoid rushed, unusual transactions. The overarching principle: your financial life can be transparent, manageable, and safe when you document everything, understand how patterns appear, and work with professionals. The $10,000 rule hasn't changed, but the way it's monitored has, and seniors must be aware to stay protected. Looking ahead, automation, data, and pattern analysis will only continue to grow. Clear records, organized accounts, and professional guidance are no longer optional. They're essential. But these steps don't limit your freedom. They empower you to manage your money confidently. Normal activity, documented properly, keeps risk minimal. At the end of the day, you've earned the right to use your money freely and safely. Being informed and prepared ensures that decades of hard work remain secure. Share this with someone who needs it, and remember, clarity, documentation, and professional guidance are your best tools for financial confidence in 2026 and beyond.